We're going to be talking about the London breakout strategy here today. As we discussed earlier, this is one of the ways that you can look to take advantage of the London market as it gets started. The strategy that we're going to be talking about does have to do with the European session, but that by no means means that we are confined only to trade European currencies. You can look to trade this any currency pair that you want, all right? Any currency pair that you want. This is going to be based off of 8 a.m. GMT. So make sure that you go onto your favorite web browser and look up what your corresponding time is for Greenwich Mean Time, London time, right? I cannot go and make this check for everyone, so please make sure that you are checking for your appropriate corresponding time for 8 a.m. GMT. Any questions on that before we get started? This is going to be based off of 8 a.m. GMT. Okay, so let's discuss the London breakout, shall we? For this strategy, once again, it's going to be based off of 8 a.m. GMT, and it is intended to help you take advantage of the opening of the London market. It's intended to be used during the London session, and we're going to look to use it within 10-minute chart, or you can use a 15-minute chart if you don't have access to a 10-minute chart. So, with a 10-minute chart or a 15-minute chart, we need to wait for the close of that candle, close of the London candle, before we can look to do anything, because we're going to be using the wick values of that candle's high and that candle's low. Apologies. Sorry, this isn't my house. One second. Okay, I think it might be done now. I was wrong. Apologies. We're going to have to power through that. We're going to be looking for the close of that candlestick formation to make an entry into the market, or to place our pending entries into the market. We're going to place our pending entries instead of how we typically would with a fundamental announcement, where we're going this house is just a smorgasbord of all kinds of crazy sounds. We're going to be looking to place our pending entries 15 and 15. Okay, 15 pips above, 15 pips below is how we're going to go about conducting entries for the London breakout. Okay, so the reason why we're doing this is because the majority of Forex transactions tend to take place during the European session, right, during the London market, from 8 to 9 a.m. GMT. 8 to 9 a.m. GMT. So as a result of that, we can look to take advantage of these as well. We just have to be paying attention to when the announcements are taking place, or excuse me, when the market opens. So that's why I keep insisting that you guys find what is appropriate, your corresponding time to 8 a.m. GMT. Now, we're going to be looking to take advantage of the initial breakout from the start of the day. So 8 to 9 a.m. in London time is roughly 3 to 4 a.m. in New York time. And here's what's important. Remember, the Forex is a 24-hour market. Okay, so that means that if you open up any currency pair, any chart, any time frame, at any time of the day, you're more than likely going to find some kind of market movement. You are going to see the markets moving in some way, shape, or form. As long as it's not Saturday, you'll be able to see the markets moving in some shape or form. They move the most during the European session. They move a little less during the New York session, and they move the least during the Tokyo or Asia session, which is what we're in right now. So the only difference is the volume, how much they move with the different times of the day. And again, most of it, since we have more countries trading at that particular time of the day during the European session, that's when you're going to have the most market movement occurring. All right? Any questions on this before we get going into the strategy? Okay, so here's a strategy. Actually, before we get into that, when it comes to trading the strategy, actually there were some important things that I left out. When it comes to trading the strategy, remember that we're going to have the most opportunity. I don't want anyone to trying to use this during the US session, or least of all during the Tokyo session. This is the London breakout strategy, so it's designed for the European session only. And the reason for that is because it's essential to have volume in order to be able to make a strategy like this work, a straddle strategy work. So you're going to have the most of that volume during the London session. That's when we're looking to take advantage of this strategy. Do not look to do it at another time. This is going to be a one and done strategy, ladies and gentlemen. So if we get taken in, right? If we get taken in for an opportunity and we get stopped out, that's it. We're not going to chase the market. If for whatever reason we're unable to set up the entry in a timely fashion and we don't get taken in, that's it. We're not going to chase the market. All right? It just is what it is. It's going to be a one and done. No chasing the market. But also, of course, there's no guarantees, so there's no way of knowing 100% that this is going to work every single time. There's no such thing in the market. We're looking for this to work the majority of the time. And of course, I'm going to teach you this thoroughly so that you can go ahead and back test it on a currency of your choosing when you have the opportunity, if you have any interest in using this strategy. This is the actual strategy itself, and feel free to screen capture this. You should have a little screen capture icon on the top right of your screen of this window. You can screen capture this if you need it. All right, we're going to discuss this in detail here conceptually, and then we're going to take a look at it on a chart, and then you guys can give me a currency pair of your choosing, and we'll go ahead and we'll do some testing on that. Okay, so the first thing that we're going to do after we've identified our equivalent, for 8 a.m. GMT, right, we are going to place lines, right, for a pending entry buy and a pending entry sell 15 pips above the candle wick high and the 15 below. Right, 15 pips above the high and 15 pips below the low. Once we've done that, we've identified our straddle values where we'd like to be taken in depending on where the market decides to jet off toward with the market open. Once we've done that, we're going to be looking to be taken in when the market breaks out, right? So in order to protect ourselves, what we're going to do is we're going to use the opposite of whichever entry price gets triggered as the stop loss, right? We put those two lines, a pending entry buy price and a pending entry sell price. If the entry buy price gets triggered, then that's what I'm going to be looking to do. I'm going to be looking to buy the market. Right? And I'm going to use my stop loss price, my sell price as the stop loss. If the market moves in the direction of the bears, though, and my entry sell gets triggered, then I'm going to use my entry buy price as the stop loss. So that takes care of my entries and my stops no matter which direction the market decides to go when the European market opens up. So how do I get out? I'm going to identify the limit by subtracting the straddle prices. So I'm going to subtract the difference between the two prices, or you can use your ruler tool to measure the distance between those 2 points, the entry buy price and the entry sell price. And once you identify that distance, right, if one way or the other, one is going to serve as an entry, the other one's going to serve as a stop loss. So if we measure the distance between those two prices, then we'll know what our total risk is. And once we identify the risk, we can look for a limit target. This is one of the only strategies that allows you to go for an equity management of 1-to-1, right? 1-to-1 is permitted for this strategy. However, if your win-loss percentage in general as a trader is not that high, right? If it's less than 50%, or if you've back tested this on a currency pair of your choosing and you find that it's less than that, which you shouldn't, but if you do find that, then we should be looking for a higher equity management. Okay, so we should be looking to go for 2-to-1. You're going to make the decision as far as if you want to trade this conservatively or if you want to trade this aggressively before you get into the position. All right, that way you know where you're going to be looking to place your limit target. So we're looking for either 1-to-1 or 2-to-1. Any questions on this? Okay, so here's how this typically plays out. We've got the 8 a.m. GMT candle, in this case 3 a.m. Eastern time. So once that candle appears, what we're going to look to do is we'll look to place the values 15 pips above that candle wick's high and 15 pips below that candle wick's low. Once we have those lines placed, 15 pips above for the buy, 15 pips below for the sell, if the market should go up to touch the buy price, we're going to look to buy the market. If the market should dip down and touch the sell price, we're going to look to sell the market. Okay? You could typically look to set this up as an OCO. All right? In order to set it up as a complete OCO, right? Because we also discussed as far as stop limits, which we never trade without. Stop loss. We never trade without a stop loss. So we talked about the stop loss. If the market triggers the buy entry price, then what I'm going to do is once my buy is in, I will use my sell price as a stop loss for that buy. Or if the market were to dip aggressively in the direction of the bears and trigger me in selling, I would use what would have been my buy price as a stop loss for that. Any questions on this? Okay, so I'm going to, if that's the case, if one way or the other, one of these is going to serve as an entry, the other one's going to serve as a stop loss, or vice versa, then that means that I'm risking the total distance between these 2 points, yes? So I want to find out just how much that risk is. I can subtract the values one from the other, or I can simply use the ruler tool and measure the distance between those 2 points. Once I measure that distance and I know what my risk is, then I'm going to use that to be able to identify my reward. So I'm going to make the decision as far as, do I want to be an aggressive trader or do I want to be a conservative trader right now? And then I'll move on to identify my reward. I'm going to look for a reward. In this case, the risk was of 38 pips. So if I decide that I'm going to be an aggressive trader, then I'm looking to go for 2-to-1. An aggressive trader will have the lines, the entry lines, and they will have their aggressive limit targets drawn out. A conservative trader will have their entry lines and their conservative limits drawn out as well, because these lines also will double for stop losses. Okay, so let's take a look here. In this case, the sell entry was triggered. The market dipped down the direction of the bears, triggered the sell. All right, so with the sell triggered, I'm no longer interested in looking to buy this market with this particular strategy. With the original London breakout strategy, I'm not interested in buying the market in any way, shape, or form. I've been triggered into the sell position. That's what I'm looking to do. And I'm going to look to hold my sell position until I either get stopped out or my limit gets hit. Right? I'm only looking in this case for 38 pips if I'm conservative. If I'm aggressive, I'm looking for twice what I'm risking. With the aggressive movement of the market, during the European session, this market was very easily able to satisfy the target and continue further than that to fulfill the bearish limit. Right? Any questions on how this is supposed to be executed? Any questions on this whatsoever? Okay, so let's transition over then to the requests. Right? If you have a currency that you would like to practice this on, please go ahead and indicate that in the question box. If you have a currency that you would prefer, go ahead and indicate that in the question box. Okay, the first currency that I'm seeing here is for the Aussie Kiwi, all right? And Scott wants to take a look at the pound yen. Okay, so which is it going to be? Stanley says, do you always use a 10-minute chart, Stan, for the London breakout strategy? Yes, you're going to use a 10-minute chart. If for whatever reason you don't have access to a 10-minute chart, a 15-minute chart is acceptable, but we prefer the 10-minute chart. Okay, let's go with the pound yen, excuse me. Let's go with the pound yen. I'm going to go over here to my teaching workspace. We'll open up a pound yen chart. Okay, charting, new chart, pound yen chart, 10-minute time frame. Okay, with the chart open, when it decides to load, there we go. We go ahead and we're going to look to identify the opening of the candle. Now, here's one thing that I want to suggest, okay? There is an indicator that can help you to easily identify the time, the start time, right? How many traders take the time to identify their corresponding time to 8 a.m. GMT? If you have and you know what your corresponding time is to 8 a.m. GMT, please indicate that in the chat box. All right, perfect. For those of you that took the time, you'll be able to use this to your advantage, right? There is an indicator. If you go here to your indicator section, I'm going to click on this, and I'm going to add this indicator to the chart twice. I'm going to go to the indicator section, reveal my indicator options, and I'm going to locate the paint at time indicator. All right, here it is. And I'm going to add it twice. So I'm going to double click once, double click a second time. My charts are set to Eastern time. So since my charts are set to Eastern time, that means that I'm looking at, it's now daylight savings time. So it's going to be 4 in the morning to noon. Right? Those are the corresponding times for Eastern time for my charts. So in order for me to do this, what I would do is for the first one, this is going to be for my start time. I'm going to go ahead and click on the paint at time, and I'm going to put this here to be at 4 in the morning. Okay? And I'm going to change the draw type to a vertical line and change the color to green for go. All right? So I've changed my first paint at time indicator to the start time when the session begins. And I'm going to do the same thing for the second paint at time indicator. For the second paint at time indicator, I'm going to put in the stop time. So since my charts are based off Eastern time, that would actually be 12 p.m. post-meridian lunchtime. All right? And I'm going to also change the draw type to a vertical line, but I'm going to leave it at red for stop. Okay? So I've got one paint at time indicator that's set to the start of the European session, and I've got the other paint at time indicator that's set to the end of the European session. So when I click on OK, these lines are going to pop up on my chart and let me know. For example, if I were to get started and I get triggered into a position, it'll let me know when it's time to pull the plug if I haven't been limited out. Right, so today, if I'm not mistaken, this is today. I'm sorry, this was the 3rd. Which is today. It's still the 3rd. I keep forgetting it's still the 3rd over there. This is today. So this is today's London breakout. This is how it went. This is how it happened. Okay. This is the candle. When the candle closes, I am now ready to begin to put in my lines, right? So what information do I need to be able to put in my pending entries? What am I basing this off of? Exactly. Based off the candle wick high and the candle wick low. So if I click on this, it shows me that the candle wick high for this was 139.71, approximately 139.71. So let me take this down. 139.71, and the candle wick low is 139.61. 139.61. So I'm going to go how many pips above, how many pips below? Exactly, 15 and 15. Perfect, 15 and 15. So 15 pips above would put me up at 86. All right, that would be the pending entry buy price. We're going to go 15 pips below here, down to 50.46. Come on, one more tick. Ah, of course. Right? So we're 15 pips above, and actually it should be, yep, 15 above, 15 pips below. So the next step then is going to be to measure the risk, right? This is going to be my pending entry buy price up here, and entry buy stop. And this is going to be an entry sell stop. By the way, any traders in the room that don't know the difference between an entry buy stop and entry buy limit? If anybody needs that explained, now is the time. Please let me know. Next up, I'm going to be looking for limits. Okay. So I've got my entry buy and sell prices. I'm going to go ahead and look for my limits based on my risk. So I'm going to measure the distance between these 2 points, and it looks like I've got a risk here of about 40 pips. Since I have a risk of 40 pips, if I'm going 1 for 1, I'm going 40 pips. I'm going to try to capture 40 pips in either direction. If I'm going 1 for 2, I'd look to try to capture 80 pips in either direction. All right? So in this case, I could simply measure 40 pips to the south down to 0.613906 for the bearish limit. And for the bullish limit, we'd be going up to, I can barely see that price point because that's in the way, 139.86, so we go up to 140.26. Edit. .26. Okay, so we are 40 up, 40 down, 1 for 1. Any questions on this? This would be my bullish limit target up here. This would be my bearish limit target. At this point, all right, once I have these numbers, I can set these up as 2 separate pending entry orders, or I can set this up as an OCO. I'm only looking to trade one of these, right? I'm not looking for a one and done. Excuse me, I'm not looking for a stop reverse. I'm looking for a one and done. Apologies. All right, looking for only one direction. So I would go ahead, I could look to set up my OCO. In this case, I would go up here to trading, create my OCO, a simple OCO, and then in the OCO window, I'm going to select my currency pair. In this case, this would have been the pound yen. So I went through and I selected the pound yen. Then I put in my lot size according to what I felt comfortable with as a trader, what did not violate my equity management. Then I went ahead and selected entry buy stop from the list and entry sell stop from the list because I got my buy stuff I want to fill out over here on the left and my sell stuff I want to fill out over here on the right. And I gave myself the ability to have a predefined stop loss and limit for both of these. All right, so last but not least, the only thing that I had to do then was to fill out the entry prices, stop losses, and limits. So for the bullish entry price, that would go right here, the entry buy price of 139.86. The stop loss price of 139.46. And then the bullish limit price of 140.26. For the sell, though, I went at 139.46 for the entry sell. Entry buy price, stop loss price. Okay, for the entry sell, 139.46. Good. I want to make sure I didn't have it backwards. 139.46. Stop loss price, 139.86. And the bearish limit price down there, 139.06. Okay, and then when I clicked on OK, I ended up with that straddle in place. Right? As the market moved along, right here I have a trigger. Shortly after that, maybe 30 minutes later, I got a trigger right around 4:30 in the morning. And so about an hour later, I get a trigger and the market starts to move in my direction. Boom. Shortly after that, this was limited out right around 5:10 in the morning. If you went for the more aggressive, for the 2-to-1, I believe this market, actually look at that, it scored that point and then pulled back. But you can hold the position. Look at that, it went another, did it go aggressive? This was another 72 pips dip further, right? I could have held the position. Had I not been limited out, I could have held the position And right here, no later than the close of the European session, close at that point in time with whatever was positive. Okay, any questions on this? This was today. This is how you go about setting this up. All right, let's do some more examples then. We'll do some back testing on this. All right, let's see what this did last week and see how we're looking. All right. Got some consolidation here. Right? The way that you back test this naturally is you're not looking for, you're gonna do this in the most idiotic way possible, right? As if you were just gonna blindly take every single entry. That's how you back test. Why? Because we want to find out what worst case scenario is. So I'm gonna take every single entry regardless of, not literally, right? But I'm going to test this as if I were to take every single entry, and I want to see if this is still profitable, if this would put me in the negative if I were to trade this, etc., etc. Naturally, we're not going to be blindly trading this. We're going to consider things like fundamental announcements taking place and potentially looking to set up for those instead, etc., etc. But I want to know absolute worst case scenario. If I were to completely screw this up and do nothing but follow the rules, right, and not consider anything else, how bad can it get? So right here, last week, the 24th, this is 4 a.m. Eastern time. I got a candlewick high of 139.05. Right, so let's take this down, 139.05, and a low of 138.88. So first thing that we do, 15 pips above. So this 139.20, and we're going to go 15 pips below down to 73. All right, 139.73. It should be 139.73, not 138. No, 138, that's right. 138.73. Sorry about that. 138.73. So verify. Yep, good, good. Okay. 15 pips above, 15 pips below. We measure our risk here, yes? Our risk is a 47 pips. So 47 pips to the north will put me up at 67. It just dances right over the number that I need. Right up at 67. And right here we're going to go 47 pips to the south, if I'm not mistaken. So let's measure 47 pips to the south from 73, 47 down. We're going to go here exactly to, actually it won't let me go any further because 47 pips to the south. 138.25, 138.25. All right, 138.25. Okay, so let's see what this market did. Got the market starting to move sideways, sideways, sideways. Here's a trigger. Okay, so at this point in time, what happens? Am I keeping my entry buy position set? Not at all. The entry buy position gets canceled. Right? And I'm in a sell position. I'm only looking to go for the sell this is my stop loss price. All right? So I'm looking to go for 47 pips. The market kind of moves in my direction, goes a little sideways, still sideways, and here at the close of this session, I had to pull the plug right here at the close of this candle, which means technically I closed positive, but this is not a grand move, right? Not very much of anything happened here. I closed positive 12 pips. Positive is positive, yeah, 12 pips. All right, so that was that there on the 24th. The following day, I had to wait, right, for the next green signal. The following day, here's my next candle. I wait for the close of the candle. When the candle closes, I mark the high and I mark the low, 138.58. So we'll take the price down, 138.58. And the low of 138.39. So we go 15 pips above, 73. Actually, it's right there. 73. And we go 15 pips below, down to 29. No, should be, this is at 39, right? So it should be 35. Here, 25. Close enough. Okay, 15 pips above, 15 pips below. So we identify our total risk here then. Our total risk, measure the distance between these 2 points. We're looking at a risk here of 46 pips approximately. I'm sorry, 49 pips approximately. So we're going 49 pips to the north, 49 pips to the south. Measure 49 pips to the north. It'll only let me go 46 because of the view. 49 to the north, that gives me a price of 139.22. So up here, 139.22. And we're going to go to the south. It's 49 pips. 49 pips to the south, put in 157.76. 137.76. Okay. So again, this is just one for one. We're not talking about 1 to 2 or anything like that. If you want to go for the aggressive ones, again, make sure that you back test it that way. So let's take a look, see what happened. Market rallies to the north. This is a trigger in the direction of the bulls. Again, I'm not interested in pursuing anything bearish at that point. So that means that this becomes my stop loss. All right. Did the market continue to move in the direction of the bulls? Went a little sideways, tested break even a few times, rally, rally, rally. Here, close positive. Did not close, did not limit out, but ended up having to close positive here with this at 32 pips positive. Okay. 32 pips positive. All right, so that's trade number 2. Let's continue to the next day. Here's the next day. Okay, we're not factoring in that the best days to trade this are going to be between Tuesday to Thursday. We're not factoring in fundamental announcements. We're not factoring in any of that. This is just blind entry based on the rules. So here's the next green signal. Candle wick high at 139.36. 139.36. And the candle wick low price at 139.18. Okay, so 36, we're going to go up to 51. Pending entry buy price, 15 pips below would put me down at 03, 139.03. Right? So that puts me with a risk at the market. Anybody finding any of these risks unbearable? So far, we have 47 pips the last one. This is another 47 pip risk right here. Anybody finding this completely unbearable? Your typical scalper likes to look for positions where you're risking no more than 75 pips. So far, we're very, very much conforming to that. So 47 pips to the north is going to put me up at 98 here. And we're going to go 47 pips to the south. Let's measure the 47 pips just to make sure that we are nice and exact. 138.56. Edit. 138.56. Okay, and we're going to see what this market did. Sideways, sideways, sideways. Here's a trigger in the direction of the bears. So with a trigger in the direction of the bears, this becomes my stop loss price. All right? And I'm only interested in looking to sell this market. I'm going to maintain the position until I get limited out, which apparently I did, or until the close. So this is positive 47 pips. Everybody tracking with this? All right, the market continued to push. Continued to push beyond that to the south. Closed out very, very bearish indeed for the pound yen. Look at that beautiful move down to the south. All right, next day. Waiting for the next green signal. Here it is. Let's take a look. Mark the candle wick highs and lows. Candle wick high of 137.98. And the candle wick low of 137.81. So 15 pips above, up to 12. And we're going to go 15 pips below, down to, what was the price point? Okay, 81. 66. You can get this to stick on the, there we go. Okay, so perfect. 15 pips above, 15 pips below. We've got ourselves a risk here of 46 pips, which means 46 pips to the south. We'll go ahead and do that right now. 46 pips to the south. I'm looking for 137.20. 137.20. Actually, it should be 19 if it was 47 pips. Actually, no, it was 40. Should have been 46 pips. So right at 20. And 46 pips to the north is going to put me up at 58. Nice. All right. So once again, same as always. If it triggers, that's what I'm taking. Immediately after the open candle, the very next candle would have triggered you in, right? So there's our trigger right there. If you missed that entry opportunity, then you missed it. If you didn't have this set up to trigger, by the time the market reached that wick high, then we would have just missed it. All right. So let's say you've taken the time to practice and you've gotten proficient here with your broker platform. This would have been our trigger right there. This is a stop loss. Okay, sell position gone. Not worried about selling the market. Market goes sideways here, goes very negative, pops positive again. Boom, stopped out. Here's my first loss, 46 pips. 46 pips. Okay, put it right by the candle where I got stopped out. Anybody having any difficulty tracking this? This is how you're going to go ahead. You're going to back test this. You will back test this for however long you want to, right? Take a look at what this has been up to over the last week, several weeks, and then you're going to figure out if you are profitable most of the time, then it could be something that you can look to incorporate into your trading methodology. Right? Could be something for you to consider. We're going to go ahead, traders, we're going to come to a stopping point here. When we come back, we're going to continue, but we're going to be talking about the modified London breakout. Right? So with the modified London breakout, there are some traders that don't feel extremely comfortable with this methodology because it's a full straddle, right? So with a full straddle, you're waiting for the market to trigger you in either in the direction of the bulls or in the direction of the bears. And that's that. Whichever direction the market triggers you in, that's what you're looking to do. Now, for those traders, what we've done is we've incorporated, in order to comply with the rules of the Ultimate Traders package, what we've done is we've kind of kicked it up a notch with the modified London breakout, where we're incorporating the rules of the Ultimate Traders package, gaining knowledge from the larger time frames, and looking to only set up one entry in the direction that has the highest percentage chance of success. And we're going to discuss that in greater detail when we return. We'll be back at 10:30 p.m. Eastern Time on Analyst on Demand.